Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Selecting an Option Strategy. I'm standing in as presenter. Our normal presenter will be back next week, but I think this is a great topic. It's one that a lot of traders struggle with because in the world of options trading, there are dozens and dozens and dozens of option strategies to choose from. So how does a trader narrow that field of candidates down to just one strategy that seems to be in alignment with their outlook for a stock or for the markets? Well, today we're going to be asking ourselves a series of 3 questions to hopefully narrow that field and give us some focus on a single strategy. How do we pick just one strategy? Here's an example potential protocol. Now, before we can go to putting that into practice, let me first of all say hello to everybody that's already chatting in out there in YouTube. Hello there, Eva and Tony, Dragon Rider 108, Josh, Will, David, Frankie, Life in the Fast Lane, Scott, everybody else. We always do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, if you're watching the recording of this webcast, enjoy the show, but be aware that you're invited to join the live discussion. This is a Tuesday webcast series, not usually taught by me. That's okay. We have a fabulous crew of presenters, and they all do a great job. But yeah, Tuesdays at 4 o'clock Eastern, right at closing bell is when you want to join. We'd love to have you here in the live stream. I also want to let you know that we have the great privilege of having my very good friend Ben Watson hanging out in the chats. Ben and I have been working together now for a couple of decades, and we all know what a great presenter he is and what he brings to the table. So thanks for being there to back me up there, Ben. And Ben and I would also like to issue an invitation to everybody who's watching. Whether you're watching live or you're watching on the archive, make sure that you're following your favorite presenters on X. That's the best place to connect with us in between the live streams. You can find Ben on X at Ben Watson CS, and you can follow me there at Cameron May CS. So with that accomplished, though, let's go right into this. And the very first thing that we always need to do is to consider the risks associated with investing and trading. Risks certainly apply to options trading, so these disclosures are important. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's talk about what we're going to talk about. The agenda for the day. We're starting off with so many different option strategies that a trader might choose from. So how do we narrow that down? Well, I'm going to outline 3 questions that a trader might ask themselves about the current market conditions and about the stock that they're intending to trade. Then we're going to apply that to current market conditions, apply that example protocol to see if we can narrow the field down to an individual strategy. And we're even going to walk through how a trader might place an example trade for that strategy. So that's what we're going to be doing today. Let's get right to it. Let's go right to the thinkorswim desktop trading software platform. There's a bit of a mouthful for you. And I'm going to go, let's outline our 3 questions. Okay? 3 questions that a trader might do in attempting to address how do we narrow it down to just one strategy. Number 1 is some strategies are bullish, some are bearish, some are neutral. So before just willy-nilly applying those, or maybe the trader feels very confident with their bullish strategies, and yet the markets are persistently bearish, that could still be a tough way to try to make a profit. So our first question is going to be bullish. Well, let's spell that correctly. And let me just abbreviate it. Bull, bear, or neutral. Because there are strategies that might fit in any of those categories. But by narrowing in on one of those, we eliminate the other 2, and it really shrinks the field of potential strategies. So that's a big, important, might be the most important question, because if we're applying bullish strategies and the markets are persistently bullish, that trader's probably going to do okay. At the same time, though, if we're applying bullish strategies and the market is persistently bearish, that trader is very likely to struggle. It's a very important question. Next question, number 2. Regardless of these strategies, each of these can be constructed either primarily by buying options or by selling options. It's tempting to apply what generally applies to stock trading to options trading. Generally, buying is bullish in stocks. It's bearish when we sell. That is not universally the case, nor does it even tilt one way or the other, buying or selling. We can buy calls, for example, to be bullish, or we can sell puts, also be bullish. Buying and selling, both delivering the potential for bullishness. So the question here might be for the trader, well, is it more of a market for buyers or is it more of a market for sellers? Now, finally, our third question, as we're narrowing that field down further and further and gaining more and more focus on which strategies might suit a trader's outlook. Some trades, some option strategies can be constructed to carry very high reward potential. And as a matter of fact, with some strategies, they have unlimited reward potential. That doesn't mean they're always profitable, though. Typically, there's a trade-off. The very high reward potential strategies are typically, on a per trade basis, unprofitable. They have a low probability of success. So the trader might want to balance. Are they putting an emphasis on the reward potential of the trade or on the probability of success for the trade? So asking these three questions really does provide a lot of focus on specific strategies that might be appropriate for what that trader would like to plan. So let's go ask ourselves this first question. How might we address this question? Are we going to be trading bullishly, bearishly, or neutral? Well, let's go to our chart of the S&P 500. And as I do this, let me throw this out for you. If you were planning a new bullish, I don't want to poison a well that way. Let me just backpedal for a second, rephrase my question, because we'll see where this takes us. But if you were planning a trade, an options trade, for the next 30 days, the next month, that's what we're going to be doing, about a month on our trade. Do you think the markets are more likely to be bullish, going higher, bearish, going lower, or sideways? Now that I've sort of stumbled over my tongue a little bit, let's go to the charts, have a look at the S&P 500, and I think a lot of people might be inclined to say this was a rough day. The S&P is down 1%. Look at this big red candle. If that momentum carries forward, maybe this is going to take us down for a few more weeks, maybe a month, and we wind up down here. In that case, maybe the trader might want to say, well, okay, let's do some bearish trading. That might tilt the scales in the favor of the probabilities for that trade. That's what they might hope. On the other hand, others might look at this and say, sure, we've had a down day, but really that's taking us pretty close to a support level that has now held for nearly 2 months. It was previously a price ceiling. So it looks like around that 58.50, 58.70 level for the S&P 500. That seems to be a possible support, and it's coinciding with an upward trend line that's been largely intact for years now. So maybe our trader says, bad day, but the positioning might look like it's more bullish than bearish. And in that case, they might be leaning toward bullish. But there could be a third case made here. Really net, the S&P hasn't accomplished much over the last couple of months. And possibly the most productive approach over the last couple of months has been kind of neutral. So not always is there an absolutely clear, definitive answer when looking at a chart, which way the trader might go for a given time frame. But let's just say that our hypothetical investor here is looking at things and they say, yep, red down day, neutral overall for the last couple of months, but I think we're on the low end of even a sideways pattern. And maybe they think that we're going to bounce. Let me cancel this. I want to draw a trend line here. Maybe they think that we're going to bounce off this support and head higher, moving beyond the January contract expiration into the February expirations and on toward maybe the third week of February. So that's an important decision. Really, for the other two questions, if we get this one wrong, I don't know about the future for this trade. If we can get this one right, though, I think that we've really helped the likelihood of success on a trade. So for this one, we're going to go with a bullish trade. And that, we've answered a big question, but we've also accomplished a huge step in narrowing the field of potential candidates. We have dozens of strategies, but some of those are neutral, taking those off the table. Some of those are bearish, we're taking those off the table, and we're left with just the bullish strategies. So yeah, we've whittled that down enormously. But within those bullish strategies, as I discussed earlier, some can be built around buying options and some can be built around selling options. So another question to my audience, is it more of a buyer's market or more of a seller's market for options right now? What do we think? There's not a right or wrong answer here. So if you happen to chat in, give one answer, and then I give the discussion and I come to a different conclusion, doesn't mean that either one of us are right or wrong at this moment, because the only thing that'll demonstrate that is what happens from here forward. None of us have that perfect insight. So is it more of a buyer's market or more of a seller's market? Well, how might a trader address that question? Well, one way they might do that is look at a chart of a volatility index like the S&P 500 volatility index. Eva's saying it's more sell, sell, sell. Of course, it depends on the underlying. Also an accurate statement there, Eva. Them Brothers Goofy says it's more of a seller's market. You know what? I'm going to skip to the spoiler. Yeah, that's what I was thinking as well. So here, this chart of the VIX, the volatility index of the S&P 500, is commonly viewed by options traders as an indication of the general pricing of options. When this chart is high, it means options prices for most stocks are on the higher end of their scale compared to maybe where they've been in the past. So, for example, back here in August, options traders who were looking to buy options were paying pretty high prices. Options sellers were receiving pretty high prices. Now, when the VIX is low, typically options prices are also low. And for some, when they're trying to buy, well, what do you think? Are we looking to buy when prices are really high and possibly falling? Or are we looking to buy when prices are comparatively low and possibly set to rise? Yeah, typically the trader might look at a scenario like here in the first week of December and say volatilities are low, markets are calm, and options prices have kind of settled down. Calls and puts, typically less expensive than at other times under these conditions. And so low VIX might be seen as a buyer's market. Higher VIX might be a seller's market. High VIX tends to be kind of a short-term scenario. Notice here in that first week of August, didn't last very long with that high VIX. Prices came back down to earth fairly quickly. The VIX, the volatility settled out of the market fairly quickly. So look at where we are right now. Well, we're not at absolute highs for the year. We're not at absolute lows, but most of the time, the volatility levels have been lower. So in other words, prices are generally higher than most of the time through the rest of the year. Could they go higher still? Yes. But also, could they settle back down? That seems to be a more likely scenario just based on history. It doesn't mean that that's guaranteed what's going to happen. But I'm going to say our trader looks at this and decides, you know what, this is kind of a seller's market. Prices are a little bit elevated across maybe most options on most stocks. So we just narrowed the field even further. We were left with just the bullish strategies. And then we just took a chunk out, moved out half of those that are built using buying strategies primarily. So now we're just left with the selling strategies. Well, even among selling strategies, they can be structured to carry a high reward compared to risk. But at the same time, they could also be structured to be a high probability of success versus failure. Now, what I can't deliver is both of those simultaneously. I know everybody's holding their breath saying, Cameron, give me that strategy that has a 90% probability of success. I'm going to make money 9 times out of 10. And it offers $10 of reward for every dollar of risk. I can't do it. It doesn't exist. If somebody can show it to me, I'd love to hear it. I'd love to spread the word, but nope. There's a decision to be made here. So where do we go to look to decide between reward potential or probability? Some people just look inward. Some people are a little bit more geared to be a bit more aggressive. Maybe they're confident in their trading. They want to leverage that as much as possible. And so they're inherently just pursuing higher reward strategies, just recognizing that they're probably going to trip over a lot of these trades along the way. That's sort of the nature of the thing. Others, though, they might look inward and say, I don't know, I prefer to back off. I like to get more consistent performance, maybe at a reduced rate of return. That might be their preference. There's not a right or wrong answer here. It's not that one is delivering with it a higher probability of long-term success versus the other. Now, another thing that the trader might do, sometimes they might prefer high probability trades. Other times, they might look at a trade setup scenario and say, you know what, this one just looks really good. I want to leverage this one up as much as possible, squeeze as much reward out of this as I can, recognizing that also means I'm dropping the probability of actual success on that trade, but I really feel good about this trade. Whatever. But yeah, there's a final decision to be made here. So let's go make a decision. I'm going to move over now to our example stock. I've already picked one out. Let me tell you how a trader might pick out a stock for trading options. One thing that a trader might look for is just the price of the stock. High price stocks tend to have high priced options for better or for worse, but also those higher price stocks tend to offer just more choices in structuring an options trade, so that can be attractive. But price per share can be a consideration. The liquidity of the contracts can be an important consideration because illiquid stocks can have illiquid options, and they can be quite difficult, even more difficult to trade profitably over a long time. The spread between the bid and the ask price can widen. So lots of trading volume might be another consideration. But a third consideration is to look at the chart. Some traders are very technically oriented. They like to look at charts and structure the trade idea in their mind. So I want to bring up a stock here as an example. We're going to be using Walmart today. It's not a terribly high price stock in the grand scheme of things right now. There are lots more expensive stocks out there, but it's also not in the low single digits where there might not be very many options to choose from. It is one of the most liquid stocks in the world. Also, it's had a pretty good run over these last 12 months. So a technician might look at this and say, hey, if I can just get this to just go up a little bit more, maybe a bullish strategy could be appropriate. Obviously, Walmart's going to do what Walmart's going to do over the next 30 days. But let's just say that our trader here thinks this has been a pretty bullish stock for a pretty good period of time. It's recently pulled back. And maybe, is it finding a new support here at around that $90 level, maybe 89 bucks coming off this gap? Let's draw in a line right through there. Carry this out for the next 30 days or so. So our technical trader might be looking at the overall direction. Looks like we've been heading higher for a long period of time. They think if we could just get that to do it, if we can just get to do that for another month, maybe we stand a good chance to make some money from another bullish trade. Now also they have the support. I'm going to call that about 89 bucks. What was the low of that gap? Yeah, right around $89. Okay. Eva says Walmart is still an up-and-comer. Yeah, well, time will tell. It's been up and coming. We'll see where it heads from here. But we have this question to ask ourselves. Is the trader going to pursue higher reward with the strategy they choose here, or probability? Again, if the trader is just a higher reward seeking trader, if they're okay with not having lots of wins, but just having a big win every now and then, maybe they automatically go to higher reward. Or they might just look at the trade scenario and ask themselves, well, am I really confident that over the next 30 days this is going to rally? If I am, maybe I want to go for that leverage, that higher reward. However, maybe our trader is looking at this and thinking, all right, we've come down to that support, but still in the short term, kind of lower highs and lower lows. This thing might waffle around a bit. In this case, let's say that our trader decides to forego higher reward in pursuit of a greater probability of success. I'm not saying that's the right thing to do under these circumstances. I'm just going to say that our trader in this hypothetical scenario, let's just come to that conclusion. Well, we just took a huge list of potential candidates, outgo the bears, outgo the neutral strategies, we're left with the bulls. We then took out the buying strategies and set those aside. And with the selling strategies, we've just taken out the high reward potential trades, set those aside, and we're left with bullish, selling, high probability strategies. So what might fit that category? Well, bullish, we can buy calls or sell puts. Structure around those two basic approaches or variations on those themes. There are different ways to do things. We decided not to buy. So we are going to be selling, we're going to be doing a selling puts strategy, a short put strategy. We could just sell a put. That's actually inherently, well, actually depending on which strike is selected, but yeah, selling a put can be set up as a high probability trade, but it carries with it also a large risk. A short put is an assumption that the price is going to go up. If it goes down, there's a lot of downside risk on a cash secured or naked put. So I'm going to be doing a bull put spread, also known as a bull put vertical spread, which is a bullish strategy built around selling that, once again, depending on strike selection, can be structured for a high probability of success. Eva says, are we going to be leaps? Are we going to be doing a leaps short put spread? Could be done. I'm not going to be doing it today, Eva. I set out with the objective that this one's going to be about a 30-day trade, so that's how I framed the whole thing, but could be done, right? Nope, let's go do a trade on Walmart. And I'm going to go out to, in the options chain, we have some contracts that expire in 3 days, 10 days, 17 days. You know, here's one expiring in 31 days, 7th of February. We could go to the monthly expiration, which is 45 days out, but there's one thing that some traders sometimes get a little bit skittish about. What's happening right before that 21st of February expiration? There is an earnings announcement. Now, that could come in and benefit the trade. It could also come in and destroy that trade. For some traders, they prefer just not to take the chance. And I'm not saying that all traders make that decision, but for today, we're going to do that. So we're going to go before that. Let's go with the one expiring on the 7th, 31 days from today. And here's how we're going to structure our example trade. Our example trade is a bull, not an bull, but a bull put spread. And it consists of two options. We're going to go to the 31st of January. We're going to sell an option and we're going to buy an option. Now with support sitting right there around 89, maybe 89 and a half. How about we do for this trade? Let's look to see if we can squeeze some juice out of selling the 31st of January, $89 put. That looks like that's trading between 87 and 114. What we're seeing right now are some pretty wide spreads due to some skew that's happening in the after hours market. These spreads were much narrower when the stock was actively trading. Right now, markets are closed. For those that are watching on the archive, you're watching the recording of this session. This is being recorded after the markets have closed. And what can sometimes happen is that the spread between the bid price and the ask price widens substantially after market close. But in any case, it looks like we're trading somewhere between 87 cents and 114. Let's sort of split the difference there conceptually and say, maybe we can sell this put for $1. Okay, that's half of our intended trade, but let's talk about that half. If we sell this put and we collect $1, what's happening here conceptually is someone is paying us $100 for the right to be able to sell shares to us for $89 a share. They can put shares to us. We're selling them this put. They own the put. They have the right to put the shares to us. Well, they're most likely to do that if the stock goes down, and then they are then able to sell the shares to us for more than they're worth. If the stock goes up, they would be undercutting the market price that they could sell shares for, so that makes it less likely. All right, in either scenario, it's possible that we could be assigned these shares. But this is why it's a bullish trade. If the stock goes up, it becomes less likely that we're required to buy the shares. And then if the time runs out, we just keep the $1. Problem is, if the stock goes down, we know how much we have to buy the shares for. We have no idea how much we'd be able to sell those shares for if the other party in this transaction decides to exercise their right to sell the shares to us. So to address that potential scenario, we're going to buy a put. Same expiration to cover this short position. We're going to buy a put, but we're going to do one that's less expensive. How about we go up a few bucks? How about we look at this $86 put? Let's buy the $86 put. And that looks like that's trading between 24 and 40 cents. Again, splitting the difference there. Let's call it 30. I'm just going to say 30 cents to keep our math nice and simple. Nice round numbers are always nice as a presenter. MC, no. Good question. Oh, by the way, as I look here at the chats, I just saw that there is a survey that's been posted to the chat window for those that are here in the live stream. So let me hit the pause on the presentation for just a moment. If you're here in the live stream, do me this favor, click on that survey link in the chat window right now and have that survey ready so you can give me some honest feedback at the end of the presentation. It's always appreciated. It's a very short survey, 2 multiple choice questions, a comments box and a suggestion box. And if you take the time to fill out that survey, I promise you I'll take the time to read it. That information comes right to your presenters and it helps. So it's not one of those surveys you're always wondering when you're filling out a survey for some huge corporation. I wonder where this goes and what executive is going to bury this at the bottom of their death pile. Nope, this one goes right to your presenter, so it's not a wasted effort. Okay, in any case, thank you for doing that. But back to the presentation. What does this long put do for the trader? Well, it gives us a definition for the downside risk on the trade. That's what it does. We know when we sell a put, we're getting paid, but we also have an obligation. We are obligated at any time a trader can require that we buy shares for 89 bucks. But if we own an $86 put, we now have the contractual right to sell shares for $86. So if we get stuck with them at 89, worst case scenario, now we can sell those shares at $86. So from here, we can, well, Mike, you say you don't see any of the other chatters. Mike, do this. Look up in the upper left corner of your chat box and see if it says top chat or live chat. You might want to switch that. I believe the top chat might prevent you from seeing some chatters. Switch that to live chat and it enables you to see all chats. Okay. Choriz says if you're selling puts, then you can conversely buy a call because the expectation of the stock is going up. Choriz, yeah, we've talked about that. Bullish strategies include, they're not limited to, but they include selling puts and buying calls. Yep. All right, but once we've done this creates our vertical spread, but it also creates for us a maximum theoretical amount that we can make, a maximum theoretical amount that we can lose. We can run some numbers and see, well, we don't even have to run some numbers. We can make some observations and see under what conditions can we make or lose that money. And we can even examine the probabilities of success or failure very, very precisely. So let's do that. So if we collected $1 but spent 30 cents, how much does that leave as a net credit representing the maximum theoretical gain on this trade? The most this trade is built to make is 70 cents. Now, there are lots of things that traders can do to tinker with this, and it can change that scenario. We're not going to do any tinkering or talk about it today. We're just taking this trade at face value. That's how much we're structuring this trade to theoretically make. Now, Isaiah, you're asking about other strategies that we don't really get. I'm not going to be getting into those today. Maybe your presenter will in a future webcast. But this is how much the trade can make. Why is that? Well, let's assume the stock does what we think it's going to do, and it goes on up, or it doesn't even need to go up. If it just stays where it is, it can work out. But let's say the stock goes up here to 95 bucks. This trader has the right to put shares to us for 89, but very little motivation to do so. Why would they want to undercut the price they can sell their shares for on the open market just because they have the contractual right to sell it for 89 bucks? They can sell it for 95. Makes no sense. Doesn't mean they won't. It's just unlikely. So we hit the 31st of January and they say, you know what? Keep my $1. I'm going to keep my shares. They don't put the shares to us. All right. Well, at the same time, we had the right to sell shares for 86. Wouldn't make a lot of sense to do that. We paid 30 cents for that. That's now spent money, sunk cost, gone at that 31st of January expiration. And the net between the two is we made 70 cents. And that's really any level above 90, just assuming that the short option does not get assigned. Even an out of the money contract can be assigned, so just be aware of that. Now, that's if the stock cooperates. I want to draw in my other lines here, though. So we have $89 and $86. How about we draw in some lines here at those levels? Let's get our sideways line drawing tool. What do we call it? Just a price level tool. That's it. I'm going to draw one in at 89. So that's our 89 strike. And let's draw one in at 86. So we can visualize what might happen at this level. That's close enough. 86.03 is close enough to help us visualize this. So those two lines represent our trade. Well, what if the stock collapses from here? Oh, I got to switch my tool again. Remove that one. What if this stock just really drops? Let's say, we didn't expect it, but and as a matter of fact, I'm drawing this out to the 21st of February. That's not when our contracts expire. Did I go? Yeah, I went for the 31st of January. Let's see. Let me look at something here. Yeah, that's okay. Before I launch things, I was actually going to talk about the 7th of February. It doesn't matter. It doesn't change the learning, so we'll just stick with that. Anyway, so where's the 31st of January? That's going to be right there. Let me just draw in a line so we can see this. Right there. So that's the expiration for our trade. So if the stock goes up, great, we're in position for our theoretical maximum gain. If the stock goes down, let's say it gets down here to, we're intersecting at 85. That'll still serve. At 85. If the stock's at 85 and someone has the right to sell shares to us for 89, are they going to do it? Yeah. Yep. Except with very rare circumstances, somebody's going to say, hey, Cameron, you got to pay me $89 for this $85 stock. Boom. They assign that contract, and we are stuck with these shares at 89, except, we have the right to sell those shares for 86. Not great. Buy at 89, sell for 86. It's a $3 loss, but we were paid 70 cents up front. So what is the maximum or the theoretical maximum loss of this trade? It's $3 lost on the stock minus the 70 cents that we collected net. That'd be a $2.30. Let me give this just a little bit more space here so it fits on that line. That's how much we could lose. Yes, absolutely. There is less to be made than there is to lose because we did not emphasize the reward potential of this trade. We're going for the probability of success. And the probability is in the favor of this trade, which is a more likely scenario. That we are above 89 on this date. Let me just clear out some of these lines so it's not quite so cluttered. Let me remove this one. I'll even remove this support. Let's remove this downward line. So there's a nice clean view of our trade. And let me ask that question again. Is it more likely that we are up here in the green zone for our trade as we hit expiration? Or is it more likely that we're down here in the red zone for our trade as we hit expiration? I think you can see, just eyeball the probabilities of that trade. Yeah, we're more likely going to wind up here because the stock doesn't actually need to do anything. It stay where it is. It can go higher. It can go down, just as long as it doesn't go down too far. If it does go down all the way down below 86, that's where we're in kind of hot water with this trade. We can actually see numerically, as a percentage, the likelihood of those outcomes. What we're looking for with this trade is for our contracts to just expire worthless, expire out of the money. Well, one of the columns available on Thinkorswim is something called Delta, which is, among a couple of other potential applications, Delta can tell us the leverage of the contract, tell us how much it's likely to go up or down with a dollar move on the underlying, but it can also tell us the probability of the contract expiring in the money. So if we look at $89, there's only a 32% chance that that contract expires in the money. Or in other words, there's a 68% probability. Let's throw this in here. A 68% probability of maximum success on this trade. Would we classify that as a high probability trade? Yeah. I mean, if we're calling anything maybe above 50-50, higher probability, I think we've accomplished what we set out to do here. But what is the probability of maximum loss? Well, that would be if we're down below 86. And 86 only has about a 13% probability. Let's do 13%. 13% probability that we wind up at maximum loss scenario, where both contracts are in the money. We're assigned at 89. We sell it. We exercise at 86. Buy at 89. Sell at 86. Maximum loss. Only about a 13% chance of that. And for some traders, they might look at this and say, that's just what I like. Higher probability of success, lower probability of ultimate failure. But before I go on with the trade, Therese says, I've had a stock move a full dollar up and I don't get the amount listed on the delta. What am I reading wrong? Therese, that's a good question. I don't mind a quick sidebar. Delta is only one of the three Greeks at play. I've had that question before. Cameron, you said I was going to make 32 cents on my delta. The stock went up $1. I only made 20 cents or 15 cents. Your delta's broken. Nope, it's because Theta and Vega are also playing a role at the same time. So you have to understand all three Greeks. That's it. Just maybe go watch maybe my video on understanding the three Greeks, and you'll get the answer to that. Anyway, so back to our trade here. If I add 68% probability of success to 13% probability of failure, my math says that's 81%. There's a missing 19% here, and that is right here. If the stock comes down below maximum gains scenario, well, we're not making maximum gain, but we haven't reached maximum loss either. Now we're getting something in between max gain and max loss. Maybe not making the full 70 cents, but some. Maybe not losing the full $2.30, but some. That's what might happen here. Just be aware, if we wind up below 89 and we allow this to get to expiration, here's how the dominoes might fall. Okay? Let's say we're down on the lower end of that. Let's say we're at 87 at expiration, down here closer to maximum loss, 87 bucks. Well, someone has the right to sell us shares for $89. They're only worth $87. They can do it. Yeah, they're going to do it with very rare exceptions. And so we're overpaying by $2 for an $87 stock. And you might think, that's okay. I can sell it for 86. We don't want to sell at 86 if it's worth 87, so our $86 put expires worthless. So we're put the shares at 89. We are now owners of shares maybe we didn't intend to own, and we're sitting on an unrealized loss of $2. Now, we can partially offset that with the 70 cents that we collected up front. So net, it's an unprofitable scenario of about $1.30 at that moment. It's not maximum loss, but still unprofitable. Plus, now we own shares, and that can really throw a kink in the works if those shares continue to fall in value. So that is a possible outcome if the short option is in the money at expiration, but the long option is out of the money, is allowed to expire worthless. Therese says, can you give me the link? Watch this, Therese. If you want to learn about Greeks, this is why everybody should be subscribed to our Trader Talks channel on YouTube. Subscribe to the channel. Just go down and click on subscribe right now. But on our channel homepage, there's a search function right here. So I can click on that search function. So you just look for Trader Talks Schwab Coaching Webcasts on YouTube. Let me type in Greeks here in the search function. Hit enter on my keyboard. What do you know? Understanding the vital role of the Greeks in options pricing and trading. That one will really help you out. Okay? All right. So now that we understand our trade, we know how it can make money, how much it might be able to make, and probability of success, how much it might lose, and probability of failure. We know that it aligns with everything the trader wanted from their 3 questions. We narrowed the field of candidates to just this strategy. it's time to put the trade in. So how do we put this trade in? Let's go to the trade tab. Let's make sure that we have the right symbol here and make sure that we're looking at the correct expiration, the correct strikes, 89, 86. Here's a quick way to do this. It works on a Mac and on a PC. But just remember, you can add multiple contracts to an order just by holding down the control key on your keyboard. So I'm gonna first of all click on the ask price, pardon me, the bid price for the put that I intend to sell. And that brings one up right down here, selling one. And then I'm going to go back up to the options chain, and while holding down the control key on my keyboard, I'm going to click on the ask price for the put that I intended to buy. And what that does is it just adds that put to the one that we already had, the long put, to the one that we had as a short put. And there is our vertical spread. And it looks like it's around a 68-cent credit. We were calculating about 70 cents. Yep, that spread between the bid and the ask prices can get kind of wide in the after hours trading. And from here, the trader can just pick, well, if we have $230 of risk, let's assume that we're able to fill for 70 cents. We don't know. We'll have to see if the order fills. But assume that we're able to fill for 70 cents. That would be $230 of risk for each vertical spread that we do. And then the trader can just dial up or down the number of contracts to the quantity that they intend to trade. Let's say we did 10 contracts. That would be $2,300 of risk, $700 of reward potential. Also an obligation, might wind up owning 1,000 shares of Walmart. Definitely want to be aware of that. Then we just click confirm and send. I'm not going to do that today. I just want to show how to structure that trade. I'm just sort of standing in as the presenter, so I won't carry it all that far. But everybody, we've accomplished what I set out to do today. When I launched this webcast, I wanted to talk us through just a quick review of the markets and start to address this question of how do we select an option strategy from all the dozens of strategies that are available. We asked ourselves 3 example questions. We narrowed the field of candidates down and we selected a strategy, broke it apart into its basic pieces, and then placed that trade. So I hope you enjoyed that discussion. I really enjoyed stepping in as your presenter. I'm going to let you go, but as you do go, just remember you do have those other resources. We already talked about subscribing to our YouTube channel. Make sure that if you haven't done this, you can click on the subscribe button down below. It only takes a second, doesn't cost anything, but it's the best place to find our playlists. Our YouTube channel is the best place to find the playlists of our previous webcasts. You can join the live streams right here. You can even search for topics of specific interest right there. Also, make sure that you're following Ben and me on X. You can find Ben on X at Ben Watson CS. You can find me there at Cameron May CS. And it really is, X is the best platform to connect with your favorite presenters in between the live streams. I'm only on a live stream 5 hours a week. It's not even that, 45 minutes times 5. So what is that, like 3 hours and 45 minutes? The rest of the time, the only place to find me is on X or to connect with me. So yeah, follow us there. And thank you to everybody that's already given that given a click on the like button. The thumbs up is always appreciated. I always say it sounds like applause because that's exactly how I interpret it. 38 likes out of 118 people watching the live stream right now is fabulous. Thank you. If you like a webcast, make sure you're clicking that like button. It gives the little emotional boost to your presenter, but it also boosts their webcasts in the YouTube algorithm, helps it find a bigger audience. So that's a double bonus for your presenter. Nice thing to do. So click the like button if you liked it. Okay, everybody, thanks for joining us today. I will see you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.